silver at $115. Say it out loud and notice what the mind does. Because silver isn't supposed to behave like that. Not in calm markets, not in orderly price discovery, not in a world where silver is treated like a sleepy side character that only shows up when gold gives permission. And that's exactly why the idea of 115 matters, even if the number hasn't flashed on every screen yet. Because the real story isn't the number. The real story is what has to happen inside the system for silver to even get close. Repeat this. The number is the headline. The mechanism is the warning. The verified reality is already aggressive. January has already shown triple-digit silver, with widely referenced data showing a January close around 105 and a 2026 high point around 106.58, as recently as January 26, 2026. That means the distance from 105 to 115 is roughly a 9 to 10% move. And in silver, a 9 to 10% move can happen faster than most people can update their worldview. Here's what needs to land. Silver doesn't rally like a normal asset when stress shows up. Silver rallies like a market that suddenly runs out of slack. That's why the phrase crisis warning isn't clickbait if it's defined correctly. A crisis in markets isn't always a recession headline or a bank logo disappearing overnight. Sometimes it's a plumbing crisis, a mismatch between paper claims and physical availability. Sometimes it's fragmentation. The metal exists, but it's in the wrong place, at the wrong time, under the wrong rules. And when the slack disappears, price stops whispering. Price screams. Start with the basics, because this is where most commentary fails. Spot price versus futures price. Spot is the price for metal intended for immediate settlement in the cash market. Futures are contracts that reference future settlement and, in theory, future delivery. Most futures participants never take delivery. They hedge, they speculate, they roll, they close. So the paper market can quote a price on enormous volume because paper can expand. But physical markets can't deliver infinite ounces because atoms don't scale. That tension sits at the center of every silver explodes moment, and it brings up a phrase that gets thrown around constantly, but rarely defined clearly. Registered silver. In exchange, warehouses, inventories can be classified in ways that matter. One category describes silver that meets standards and sits inside approved storage, but is not committed to delivery. Another category describes silver that is actually deliverable against futures contracts, silver that is registered, documented, and available for settlement under exchange rules. That difference matters more than almost anything else when stress hits. Because when confidence wobbles, nobody asks, is there silver somewhere on Earth? People ask, can that metal be delivered now in the form required under the rules that govern this contract? That question is where markets either stay orderly or fracture. Now zoom out to the supply and demand picture, because this is where the move toward 115 stops sounding like a meme and starts sounding like a probabilistic outcome under the right conditions. Global silver demand is measured in billions of ounces. Recent widely discussed industry figures show mine production around 819.7 million ounces, recycling around 193.9 million ounces, and total demand around 1.16 billion ounces in a single year. Stop and feel the shape of that. 199.7 million mined, 193.9 million recycled, 1.116 billion demanded. That is not a market with endless cushion. That is a market where incremental shocks matter a lot. And the deficit figure that keeps showing up in serious discussions is not small either. A market deficit around 148.9 million ounces is the kind of gap that forces the system to lean on buffers, above-ground inventories, dishoarding, and whatever supply can be pulled forward. Deficits do not guarantee price goes up tomorrow, but deficits do one critical thing: they shrink the buffer. And when the buffer shrinks, price becomes hypersensitive, not slightly sensitive, violently sensitive. So how does silver move from the low hundreds into something like 115? It happens when two forces converge. One, a demand shock or even a fear-driven scramble for guaranteed supply. Two, constraint, delay, or fragmentation in deliverable physical metal. In plain terms, not just more buyers who must have it in size and can't be easily satisfied with paper. That's why delivery data matters so much, because it's where paper touches physical. In COMEX silver, the standard contract represents 5,000 ounces. When delivery activity spikes, it signals that someone, somewhere, is choosing to settle in metal rather than roll indefinitely. In late January 2026, widely circulated exchange reporting showed month-to-date delivery totals around 13,1 72 standard silver contracts, that's 65.86 million ounces, plus micro silver delivery totals around 9,181 micro contracts, another 9.181 million ounces. Put those together, and the number sits around 75 million ounces of delivery activity across those contract types in that reporting window. 75 million ounces is not a casual statistic. Does delivery volume alone prove a crisis? No. But it becomes meaningful when it clusters with other signals: tight spreads, rising premiums, location imbalances, and any sign that immediate metal is being valued more than future promises. That's also where the market's geography becomes a hidden factor. Sometimes the issue is not a global shortage. Sometimes the issue is silver in the wrong places. Inventories can stack up in one hub while another hub tightens. And price starts reflecting stress not because the world ran out of silver, but because the system cannot move it efficiently, cheaply, or quickly enough to meet specific settlement demands. And when logistics meets fear, repricing can become brutal. Now, history, because silver has done this before with different catalysts. The famous case is 1979 to 1980, when silver ran from single digits to nearly 50. The London fix hit 49.45 on January 18, 1980, and futures traded an intraday high around 50.35. Then came the lesson most people forget. Rules changed, margin requirements tightened. The market forced liquidations. Volatility didn't politely fade. It snapped. That historical parallel is not a prophecy, it's a warning label. When silver becomes the center of attention, the response is not always let price float freely. Sometimes the response is administrative, sometimes it's structural, sometimes it's blunt. So the real question isn't just, can silver touch 115? The sharper question is, what would the system do if it tried? Now bring in the macro layer, because silver doesn't move in a vacuum. Silver is strange. It's an industrial metal and a monetary metal. It can respond to growth, and it can respond to fear. It can be pulled by electrification, and it can be pulled by distrust in currencies and institutions. That dual identity is exactly why silver can go from boring to explosive. Industrial demand can be sticky, embedded inside electronics, electrical infrastructure, and energy systems. And when industrial demand forms the base, investment demand becomes the swing. That swing is where the market can break from steady into disorderly. In an environment where silver is already holding above 100, the psychological regime is already different. Above 100, headlines change, positioning changes, risk managers change, retail attention changes, options markets reprice, dealers hedge differently. Liquidity can thin out right when everyone suddenly cares. And above 100, the market starts asking a harder question. How stable is the structure underneath this move? That's where 115 becomes symbolic. 115 is not just $10 higher. 115 can represent an escalation, a test of whether the move is a momentum surge that can be faded, or a structural repricing where the market is struggling to locate and incentivize physical supply. Now pause, because there's a smart objection that needs respect. If prices spike, demand will collapse. Yes, that is the bearish case, and it has real teeth. Bearish reality number 1. Demand destruction and substitution. When prices jump, industrial users don't cheer. They redesign, thrift, substitute, and delay. Some segments have already worked on reducing silver loadings over time, especially in areas like photovoltaics, where engineering changes can reduce the amount of silver used per unit. So high prices can cap demand growth and sometimes shrink demand at the margin. Bearish reality number 2, recycling surges. High prices pull scrap out of drawers, vaults, and old electronic streams. Recent industry figures already point to recycling hitting a multi-year high around 193.9 million ounces. That's a pressure valve, not a perfect solution, but a real supply response. Bearish reality number 3, forced liquidations and rule changes. Silver's history includes episodes where exchange margins were raised and the market was effectively squeezed from the other side. Not by shortage, but by capital requirements. A parabolic move can become a liquidation machine. Bearish reality number 4, flow shocks and liquidity traps. Even if the fundamental story is bullish, flows can crush price short-term. Systematic selling, portfolio de-risking, a big fund exiting, thin order books. In silver, a 10% drop can happen fast, and it can happen while the long-term thesis remains intact. Bearish reality number 5, location imbalances can unwind. If the issue is metal in the wrong place, then relief can come when metal moves back to where it's needed, and the squeeze premium can evaporate. So, yes, a run toward 115 is not a one-way street. But here's what those risks don't change. They don't change the arithmetic of a market that has been leaning on buffers. They don't change how slow supply response can be, because a large portion of silver production is byproduct production. It's tied to copper, lead, zinc, and gold mining economics. You don't just turn on massive new silver supply instantly because price spiked. They don't change the fact that total demand sits in the billions of ounces, which means even a modest percentage shift in investment behavior can overwhelm the short-term physical pipeline. And they don't change the most important point. When a market has little slack, the marginal ounce sets the price. Not the average ounce, not the theoretical ounce. The ounce that clears the market when everyone wants certainty. That ounce. And when the marginal ounce gets expensive, everything gets louder. Miners hedge differently. Refiners run hotter. Recycling ramps. Industrial buyers scramble to secure supply. Exchanges watch inventories. Funds chase momentum. Retail piles in. Volatility expands. That's how silver behaves when stress is real. Now, a crucial concept that separates normal markets from tight markets. Contango versus backwardation. Contango is when futures are priced higher than spot, often normal because use of storage and financing. Backwardation is when spot is priced higher than futures, a classic signal of near-term tightness and urgency. Backwardation is the market saying, pay more now if you want it now. When backwardation shows up strongly in a metal market, and especially if it persists, it can indicate that immediate physical is being valued more highly than future promises. And when that happens alongside unusually high delivery activity, the probability of a disorderly repricing increases. Now shift from theory into practical intelligence, because surviving silver is about reading signals, not worshiping narratives. The first signal is delivery behavior. Not just one day, not just one headline, but sustained delivery intensity. If large delivery totals keep printing month after month, it suggests that physical settlement interest is not a one-off. The second signal is the spread behavior, spot versus futures and near month versus far month. Tightness tends to show up in the front end first. The third signal is retail and wholesale premiums. When coins, bars, and wholesale units trade with elevated premiums that persist, it can indicate supply friction. Premiums alone aren't definitive, but they matter when they refuse to normalize. The fourth signal is inventory classification. total versus deliverable. A big number can look comforting until the deliverable portion is small relative to potential claims. The difference between metal that exists in a warehouse and metal that is actually registered for delivery matters in stress conditions. The fifth signal is how silver behaves around regime levels, especially round numbers. Silver at 50 is historical memory. Silver above 100 is a new regime. Silver toward 115 is a stress test, not because of mysticism, but because behavior changes when numbers become headlines. Now, what does a 115 tape mean for different people? For those holding physical as long-term protection, volatility is not a surprise, it's part of the nature of the asset. A move toward 115 could be followed by sharp pullbacks. That doesn't invalidate the thesis, it simply proves the point. The market is unstable when slack is gone. For traders, above 100, the risk is not just being wrong on direction. The risk is mechanics. Gaps, slippage, rapid margin changes. Thin liquidity at the worst times. A correct thesis can still get punished if risk control is sloppy. For long-term investors who want exposure without chaos, the key is sizing. Silver can be right long-term and still rip faces off short-term. Positioning that forces panic exits is the enemy. For newcomers drawn in by headlines, the most important question is simple. Is the interest driven by understanding or by fear of missing a move? Fear of missing is how tops are bought. Understanding is how volatility is survived. Now, bring it back to the core message because this is where the crisis warning framing either becomes legitimate or hype. A run toward 115 would likely signal that the market is testing the integrity of pricing and settlement across paper and physical. Not necessarily there is no silver, but the marginal ounce is suddenly expensive, and the system is forcing the price higher to attract real supply and immediate delivery willingness. That is what tight markets do. They raise the incentive until something gives. Sometimes what gives is demand. It breaks, substitutes, disappears. Sometimes what gives is supply. Recycling surges, inventories are mobilized, metal flows where it's needed. Sometimes what gives is policy. Rules change, margins rise, and speculative pressure is forcibly reduced. The only guaranteed truth is this. Silver can move violently in both directions when the market is stressed. So here is the verification call, because trust should be built on data, not drama. Check the supply and demand tables from credible industry reporting. Look at mine production, recycling, total demand, and the size of deficits. Check exchange delivery reports and watch how the month-to-date totals evolve. Compare that to price behavior, especially in a year where triple-digit silver has already appeared in widely referenced data. Then ask the real question. Is this just a speculative wave, or is the system showing strain? Now, full risk disclosure, stated plainly. This is educational market analysis, not financial advice. Silver is extremely volatile. Prices can gap, reverse, and overshoot in both directions. No outcome is guaranteed. Any participation in this market requires independent research, risk management, and position sizing that can survive sharp drawdowns. And now, the final thought, because this is the part that matters most. If silver ever truly tags 115 in a clean, sustained way, the headline won't be "Silver went up." The headline will be, "The world just watched what happens when a small, essential, tight market runs out of slack, and the pricing mechanism starts forcing reality back into the equation." And when that happens, the market doesn't whisper. It screams. And it keeps screaming until the pressure is released.